Welcome to Pioneers in Payments, where payments experts share their insights.
Other trends I can think of that perhaps are not so good. I think increased government regulation, and it's not true in all markets, but it's true in many markets. We're seeing increased interest in the regulators in the payment system. Many regulators are overseas are characterizing payments infrastructure as kind of critical national infrastructure. This may be becoming more acute post-COVID. So in a world where people were worried about incubator supply chains, drug supply chains, some are worried about payment sovereignty, if you will. You could call this payments protectionism. I think it's a negative trend, but it's not going away. And there are various layers of it. So countries demanding in-country processing. We look at India, Russia, Turkey as examples, and they demand that payment processors and networks process in-country. And they have various reasons for doing that. We look at countries like the Chinese market. China is a just enormous payments market. In 2001, China made a WTO commitment to 100% open up its payments market, domestic payments market by 2006. We're in 2022, and I think it's the case that there has not been a single MasterCard, domestic MasterCard, Visa, JCB, PayPal, Amex, or Discover transaction in China. And of course, at this point, it may not really matter because China now has three, enormous domestic payment networks. So even if they were to, in good faith, open up the market, it's probably game over. But I think protectionism is something that I worry about. Increased government involvement in the payment system. So we look at there are governments where governments are competing as operators. So in Brazil, there's an enormously successful payment system called Pix, which is run by the central bank. Launched a couple of years ago, terrific growth. The regulator, the central bank, mandated PSPs or large PSPs participate. So private sector operators don't enjoy the prerogative of mandating participation. The Fed is launching Fed Now next year. The Fed said that only the Fed could provide equitable access to lots of banks, that only the Fed could ensure that the dastardly clearinghouse didn't enjoy a monopoly on real-time payments. Well, the US real-time payments market is highly competitive already. So yes, the clearinghouse RTP is a traditional interbank real-time payment system, but Visa Direct is an instant credit real-time payment system. MasterCard Send is a real-time payment system. Zelle, from a standpoint of users, is a real-time payment system. FIS, Fiserv, and Discover all have smaller but real-time instant credit payment systems. So the US market with private sector actors already has half a dozen players competing. So this is an example of, do we need, if there's a problem in payments that for whatever reason, the market, private sector players can't address, okay, all well and good, maybe the government needs to do something. But if the private sector is adequately serving the space, I guess my view is governments should stay out. And in the case of the Fed is our financial system's paramount regulator. It has unlimited resources, and it is competing. It already does in ACH, but it will compete in real-time payments with the banks that it's regulating. And I think there's a clear conflict of interest in that. So these trends aren't going to go away. In Europe, the EU takes a view, European Commission, that payments is somewhat of a utility. Payments, and not the processing so much, but the networks. And they're very comfortable with directing the industry in what they want them to do. So we have Payments Directive 1, Payments Directive 2, we're going to have Payments Directive 3. We have price caps on interchange. We have prescriptions on separating payment schemes and payment processing. We have very clear routing from the sidelines. So from Brussels and from Frankfurt, where the ECB is headquartered, for putative content EU champions. So we just have European Payments Initiative, which is still alive. There are about a dozen banks, European banks, participating in it. Some have been bailing, but the idea was it was going to be quote unquote European card payment network, a P2P network, a digital wallet, using the ECB's instant payment tip system, and competing with Visa, with MasterCard, with PayPal, with Google Pay, Apple Pay, but would be better because it was quote unquote European. And I think that's a whole, it's going to fail in my view. As something called Monet, which was the European Commission's putative EU payment system champion about 10 years ago, which was a consortium of 24 Western European banks. And it was going to be better because it was going to be European as opposed to something that is domiciled notionally here. But there was never a compelling use case for European banks, much less European consumers or merchants. And eventually the banks bailed on this fundamentally political project. So I guess my concluding remark on this would be that the politicization of payments is something I find worrisome. It's not going to go away, but I think as an industry, it's incumbent upon us to try and push back on that where we can, because it's not good for the industry. It's certainly not good for the consumers and merchants, businesses that we as an industry are trying to serve.
I would agree with you there. Actually, I did not share. I'm hoping that I can interject a question here,
Sure.
and that it'll be okay with you, because we're talking about regulation, and I'm curious what your take is on the Durbin Amendment.
Yeah, so we have. I've been a very longstanding public critic of the Durbin Amendment, and also a critic of his current proposal, the Credit Card Competition Act. But the Durbin Amendment. So what did it do? It did essentially two things. It imposed interchange price caps or controls on debit interchange for large politically unsympathetic banks. So if you're a bank above 10 billion in assets, you're subject to the interchange price caps. If you're a politically sympathetic community bank with below 10 billion in assets, and that 10 billion in assets was simply the threshold that Durbin thought that banks below that threshold would be sympathetic on both sides of the political aisle, and above they would be unsympathetic. So what does that do? So price caps create shortages. It suppressed issuer innovation. It suppressed the economics, reduced the number of conditionalist fee-free accounts for consumers. It made it more difficult to serve the underserved. Now, we do see some regulatory arbitrage here. So much of the innovation and growth and creative new debit products. So we have the Cash App debit card. We have some of these neobanks. We have Venmo with a debit card. These are large, innovative players in the payments ecosystem that are winning share, and they're partnering with community banks under the 10 billion threshold, so that they have the fuel of market interchange. Now, if I were in their position, I would do the same thing, but I think it's unfortunate that we have that. I think the second, so price caps in the payment system, as in all sectors, are harmful. They cause the misallocation of resources, they cause shortages. And here, what we had is a government pushing down economics for issuers and the issuer and cardholder ecosystem. And on its face, some people are uncomfortable with this notion of asymmetric pricing. The idea that the merchant side is paying more, the consumer side is paying less. Interchange is a system that, setting aside that the industry sometimes tries to defend it as a cost recovery mechanism, I would say that's not really the case. The purpose of interchange is simply to balance participation. And if, for example, the reason interchange for retail payment systems almost always flows from the merchant to the issuer, then to the cardholder in terms of fee-free products and benefits, is because consumers' payment choices reign at the point of sale. So and any merchant that aggressively pushes back on consumers' payment preferences, they will lose sales. The merchants understand that. And imagine this, a counterfactual. Imagine a world in which consumers were genuinely indifferent with the between payment products. So all of us have, let's say, a dozen different payment products in our leather wallet or purse, or digital wallet or purse, and we're genuinely indifferent. So when I'm shopping at Amazon, I'm shopping at Walmart, I'm shopping at Home Depot, with the clerk, the online checkout, or the clerk at the physical point of sale says, would you please use your MasterCard debit or your Discover or whatever card? And I don't care. Well, in that world, I would suggest not only would interchange plummet, it might go negative. That is, that interchange would be paid to he who can shift payment share. There have in fact been instances of that. There was there's a payment debit network in Australia owned by banks where interchange was negative, which is to say the Australian banks for many years paid the big retailers to accept their debit cards. So now we're not in that world, but my view is let the market participants sort that out.
Right.
And maybe interchange is too low, maybe it's too high, but the most enlightened regulator at the Fed or certainly in Congress doesn't know what the right level is. And the right level today may not be the right level tomorrow. The second piece of the Durbin Amendment was a mandate that merchants enjoy a routing choice for debit and have at least 2 different debit networks over which they could route a debit transaction. And Durbin's idea, and this is clever, I mean, he's crafty, relentless, but he's a smart guy. His view was this would be a ratchet enabling a one-way ratchet, enabling merchants and merchant processors on the behalf to push down network fees and interchange. Now, it's worked less well than he anticipated, in part because the Fed took a relatively benign, from the industry standpoint, approach to implementing it, and said that an issuer could comply by having enabling two unaffiliated networks on each card or account, but they didn't have to enable 2 different authentication means, and the issuer controls authentication. So as a practical matter, most merchants don't accept PIN debit, so therefore most merchants, as a practical matter, what most bank issuers did was they continued to align with either Visa or MasterCard as their primary brand and signature network, and then they picked another network, generally one, but sometimes two, to be the quote unquote PIN network, and it genuinely was PIN. And sometimes there are cards out there that are MasterCard Visa or Visa MasterCard, but only one brand. But in addition to the traditional PIN networks. But for the merchants that didn't accept PIN, generally they didn't have a choice. And in the online world, because PIN introduces friction, and the reality is that very, very, very few merchants accept PIN authentication online, generally they didn't have a choice. So it had less effect, although we do see at the point of sale networks now paying quote unquote rebates or price concessions, if you will, to large retailers for routing. So it changed the economics. I think there was a brief opportunity when Jeb Hensarling was the chairman of the House Financial Services Committee when we went to repeal the Durbin Amendment. And it was part of a reform package, Dodd-Form reform package. He had to drop that because this ended up, if it had been a freestanding proposal, I think it would have had good chances of passing, but it wasn't. It was packaged to this complete overhaul of Dodd-Frank. So therefore it became a party line vote. So we couldn't lose any Republican votes. And the fact is that the Durbin Amendment and regulating the payment networks, it's not a purely partisan issue. I mean, it's true more Republicans oppose it and more Democrats support it, but there are Republicans that take the view that supporting price caps and interchange is pro-merchant, and there are Democrats that don't like it because they see it as anti-bank. So chances are it's going to be with us for a long time. I hope I'm wrong. Durbin, is relentless. He currently has a bill, the Credit Card Competition Act, which is also quite cleverly crafted. And it proposes something much simpler: no price caps on interchange. And of course, and his thinking there is price caps are easy to demagogue as being price caps because, well, they are. He's simply proposing credit card network routing choice, and only for banks issuers with over 100 billion assets. So we're really talking unsympathetic gargantuan banks who happen to account for over 90% of the market. And his bill would mandate that every credit card be enabled on 2 different credit card networks. And the two could not be Visa, MasterCard. This is a very much a bill that is aimed at Visa and MasterCard without naming them. But there will be nonetheless have to be 2 networks. So Visa Amex, Visa Discover, and the merchant or merchant processor on the merchant's behalf could choose between those networks. The effect of this, if it were enacted into law, would be to cause, in my view, a collapse in network fees. There'd be a race to the bottom, and they might go below 0. In fact, I think they would go below 0. Interchange, and this may seem counterintuitive, but interchange, I think, would not collapse. And it would not collapse because his bill only would require 2 credit card networks, and therefore with national coverage. So if I'm an issuer, I'm Capital One, I'm Citi, and I have enabled 2 networks, and if one of them started to lower interchange to win routing choice for merchants, if I'm an issuer, I would simply drop them. Now, the flip side is that even though there'd be increased pressure to raise interchange to be enabled, the system would only be stable if interchange was the same for both networks. Because if I was, say, a Citi card, and let's say the Citi was MasterCard Amex for whatever reason, and Amex interchange perhaps was higher, well, in that case, Amex would get 0 transactions. So from the standpoint of the issuer, you'd want to make sure that interchange was a parity. So it would set up, also likely cause networks to try and increase their quote unquote fixed fees on the acceptance merchant side, because the fixed fees wouldn't be subject to routing competition. There'd be some pressure, I say some, by the networks to try and recoup fees from issuers, but that would be problematic. We'll see where this goes. Again, like with the Durbin Amendment, he's now trying to attach this to a defense appropriations bill, because he recognizes this stuff meaning regulating the payments industry, has a hard time, in fact, has no history of moving on its own as freestanding legislation. But if you attach it to some legislation that has to pass, if you can get over that hurdle, as he did with the Durbin Amendment, then you get what you want. And who cares that the credit card network routing has nothing to do with defense appropriation. So those are my quick thoughts on Durbin.
All right. Well, thank you so much for that. I didn't share with you in advance that would be one of the questions, but my goodness, I so appreciate your response to that.